traders, and welcome to another exciting video lecture brought to you by the Academy of Financial Markets. I'm Michael Harding, your Chief Trading Instructor. In the last lecture, I explained breakouts and fakeouts, and in this lecture, I will explain retracements and profit taking. So retracements and profit taking mean similar things. It's just a different term for looking at and understanding how the market's working. So a retracement is typically when the market is sort of profit taking from usually like a nice upward movement or a downward movement. For example, as we were continuing to trade in this downward channel here and we finally got this breakout, it's only natural for anyone that got into this trade to be considering closing out some of their positions as they're looking at their account and seeing that they're up quite a bit in profit. So you can imagine, if you're one of the larger firms and you have a heavy position on this position here, and once you entered into this trade, say for example, you're up $10 million at this point, and if you're looking at your account and you're up 10 million, you're going to be tempted to want to close a portion of it, if not the whole thing. And so we get this slight retracement, or this slight, it's like profit taking time. Okay, so once we get this retracement, the market then continues to consolidate, but then as others are sort of consolidating and unsure of which way this market's going to go, other traders are wanting to lock in more profits as well, so we get more of a retracement. Okay, so we can use a Fibonacci retracement tool, and we just take it from the lows to the highs, and this gives us several levels, the most common levels that we can expect to see a retracement to. Typically, once we see a break below the 61.8%, then we can typically expect it to move back down to the 100. So in this case here, after we had the breakout, the initial retracement was down to 38.2%. We had the consolidation, and after breaking below the 38.2%, we had a slight pause at the 50%, and then it finally went down to the 61.8, and it held on to the 61.8 for further support. And after being at the 61.8%, then we started to see the continuation from this initial breakout. So it's not likely that we would ever see any, once there's a breakout, that it would just continue to move straight up. You always see a breakout, a retracement like this, continuation, another retracement, continuation, and so on. And so all of these retracements are when traders are simply locking in profits. If you get into a position and you hold on to it for quite some time and you're looking at your account and you're seeing, wow, I'm up quite a bit, it's only natural for you to want to sort of lock in some of your positions. And as you close some of your positions, other traders are thinking the exact same thing. So it's just market psychology. So that's why the market is going up and down, up and down, up and down. It's not just going straight up. Okay, so that's it for this lecture, guys. Thanks for watching. Be sure to watch the next lecture. I'll discuss continuations and reversals.